Hello, this is Team 4's team case study, and we decided to choose Disney for our case project. The first thing that we wanted to do was compare Robert Iger's salary to other CEOs in the entertainment industry. So we were able to find information from 2016 to 2018 for the CEOs for Lionsgate and NBC Universal. So looking at these salaries, you can see that Robert Iger, he made the most out of all three of them. And then looking at the CEO for Lionsgate, his fluctuated quite a bit, especially in the middle there at 2017. He made quite a bit in 2017, but the other 2 years went up and down at a very high rate. And then the CEO for NBC Universal, his stayed pretty high too, and compared quite a bit to Robert Iger in 2016 and 2017. But then Robert Iger's jumped up quite a bit in 2018, and Stephen Burke's, it stayed pretty high, but in 2018 it was not as high as Robert Iger's. The next thing we wanted to perform was the discounted cash flow analysis for Disney. So looking at the fair value of equity and then comparing that to the price of stock closing, we did perform this on October 30th, so it is a couple of months old, but when we performed this, it did come out to be $30 more than the actual price of stock closing. So as you can see here, the numbers don't quite match up, but when we do this, we did have to use some proposed values and estimations, so we think that's why it came in a little bit low. So when you are using estimations and whatnot, you're not always going to get the correct answer all the time. We then wanted to use the capital asset pricing model to perform a calculation for Disney. We used a risk-free rate of 1.85%, a beta of 0.95, and an expected return on market of 11.73, which then yielded a value of 11.23%. We noticed that with a higher rate, the more risk of Disney stock, and leads to a more likely decrease in capital expenditures due to overall increase in risk.
I'm going to talk about the industry shift to streaming, and I'm going to talk about Netflix, Hulu, Disney+, Amazon Prime Video, and Apple TV+. First, I'm going to talk about why consumers are cutting the cord and switching from cable to streaming services. The number one reason is because they are cheaper. Here you can see all of the plans that each streaming service offers. You could probably package 2 or 3 of these, maybe even 4, and it will still be significantly cheaper than paying for cable in the long run. On top of that, when you switch to streaming, you don't have to pay for box rentals, as well as not having to pay for certain TV packages. Cable companies often charge a certain fee for the number of cable boxes that they have, that you have in your home. And then they also have to pay for certain TV packages to get certain TV channels that they want. And then not every channel that they have in their TV package they're going to use, so they feel like they're not getting the most bang for their buck when it comes to their cable bill. Next, I'm going to talk about the financial analysis and stock price reaction to the Disney Plus launch for all of these companies, minus Hulu. I wasn't able to get their financial analysis because they are a private company. First, we'll talk about Netflix. Here on the left, we have just a quick little graph showing their income statement from the last 4 quarters. But one interesting thing we want to take a look at is how their stock price reacted to the Disney Plus launch on November 12th. Here we see that they had a pretty deep decrease from the 11th till the close on the 13th. But after the 13th, we see that they had quite a significant increase from then on. For Amazon, we have the same 2 graphs. And on the right here, we also see that from the 12th to the 13th, that Disney Plus launch day, they also had a decrease. But as Amazon, also being in the retail business, as we got closer to Black Friday and Cyber Monday, they also had quite a significant increase in their stock price. Next, for Disney, theirs is very interesting to see how they have handled the success of the Disney Plus launch. As you can see, they had a significant increase, and they've kept that up pretty steadily since then, and it will be interesting to see how they continue, or how their stock price continues going forward into the next couple of months. Lastly, we have Apple. Apple Plus TV launched on November 1st. So we can see throughout the course of the month, they have slowly been trending upwards, with the exception of the dip there right before holidays. But what's also interesting to see for Apple is how they reacted to Disney Plus. They show a slight decrease from the 11th to the 12th of November, but then a big spike from the 12th to the 13th, which is interesting around the Disney Plus launch day.
Hi everyone. So I'm going to talk for a little bit about the potential risks as well as the potential returns from this new Disney Plus streaming service. So there are three main risks for Disney if the Disney Plus streaming service doesn't take off. The first is the upfront costs. Disney has spent over $3 billion on the technology and the initial original content in order to get the service up and running. The second is the opportunity cost of exclusive licensing contracts with other networks and streaming services. Licensing content to Netflix and other competitors, or keeping the content as exclusive to Disney Plus, are mutually exclusive projects. Disney is giving up hundreds of millions of dollars in opportunity costs by ending its licensing partnerships with streaming competitors. Finally, Disney risks cannibalizing its own traditional cable and video revenue with the new service. There is potential for Disney customers to end their cable subscriptions that include Disney and switch purely to the new streaming service. All of these risks and costs together likely mean that Disney will initially lose money for the near future on the Disney Plus project, in the hopes of reaping the rewards in the long term. While difficult to quantify, there are a couple of specific areas where Disney stands to gain the most from Disney Plus. The first area is simply through the new cash flow stream of Disney Plus subscribers. While Disney is initially offering a low subscription price of $6.99 that undercuts its competition to fuel growth, they can easily increase this price in the future as they increase their original content offerings. At the moment, they are focused on growing their subscriber base, which will of course give them a larger base to multiply their price and increase revenues. The second, arguably more important area that will benefit Disney is by boosting their brand equity. As Disney Plus gives more subscribers access to more of their content, this will increase interest in all of their brand's properties, such as Marvel, Star Wars, and Pixar. This will in turn increase revenue from merchandising, future movie releases, and amusement park attractions. Both of these potential increases in future cash flows show that Disney has a lot to gain from its risk on Disney Plus. So for our final recommendation, although Disney is historically a safe and dependable blue chip company, the changing industry around Disney is forcing the company to take on new risks. With the rise of streaming giants such as Netflix and Amazon, Disney is forced to change its strategy in order to compete in the changing landscape. By launching their new service Disney Plus, the Walt Disney Company risks losing its large initial investment, the opportunity costs, and cannibalizing some of their own traditional cable revenue. However, they also stand to increase future cash flows directly from a large and growing Disney Plus subscriber base, as well as the other business areas through an increase in brand equity as a result of Disney Plus. Disney is making the correct choice by taking the risk on Disney Plus. Shareholders clearly see the value of the potential future cash flows, as evidenced by the upward spike in their stock price after the launch. Disney also avoids being left behind in a slowing traditional cable industry by launching this new service. Disney's strategic change with the launch of Disney Plus should position the company for success in the coming years.